In Kenya, taxation is actually a law. It is an act of parliament that was assented to on 21st December 1973 and commenced on 1st of January 1974. The act makes provision for the charge, assessment and collection of income tax, for the ascertainment of the income to be charged, for the administration and general provisions relating thereto, and for matters incidental to and connected with the foregoing. You would expect as such that it would be best interpreted by lawyers, and it is so. Knowing the basics of taxation is a prelude to anyone. The expertise is left to lawyers and tax accountants. So with that behind us now, we look at income tax in Kenya. We will define the person who is taxed as a resident of Kenya. So notice there will be a difference between a resident and a citizen. So for a person to be considered a tax resident in Kenya, they have to have a permanent home in Kenya and were present in Kenya for any period in the year of income under consideration, or someone with no permanent home in Kenya but were present in Kenya for 183 days or more in that year of income, or someone who is present in Kenya that year of income and for the 2 preceding years of income for periods averaging more than 122 days in each year of income. So those are the matters that lawyers would look at when maybe there is a case concerning tax evasion. So income is any money generated by a person in form of revenues from business, or rent from property, or interest earned, dividends earned, and most importantly, from employment. So taxable employment income in Kenya will include all payments made by an employer to an employee. These will include salaries, also wages, bonuses, and, as we shall define, fringe benefits received or enjoyed by virtue of employment. So fringe benefits will typically have a specific tax treatment, as in the case of housing, vehicles, and other benefits that we shall mention. Where there is no specific tax treatment prescribed, the taxable value will be the higher of the cost to the employer, or the fair market value of providing the benefit. Basically, what that statement means is normally in employment, a person is paid in cash, that is the salary, or in cash in form of bonuses, or wages, as we have mentioned. But there's some other benefits that come not in form of cash, but in form of other things to be enjoyed in that employment, like a personal vehicle, a personal house, a loan by the employer, etc. So what the law says or states is that if there is no prescribed way to treat that item, then we shall look at how much is it costing the employer. For instance, if the employer has rented your house and it is costing him 30,000 per month, then that will be the value of benefit that will be added together with your other incomes for purposes of taxation. But then again, we said the higher value. So if between the other option would be what is the market rental value for such a property. If it is more than 30,000, then that higher value will be taken. In other words, for benefits and where there are options, the taxman will always take the higher value. For allowable deductions and their options, the taxman will always take the lower value. So basically, taxation now becomes a game where the taxman seeks to maximize the revenue or the amount that he gets from you, and you, as the person who is paying the tax, you have to look for ways of avoiding paying a lot of tax. Notice the word here is avoiding, not evading. Evasion of tax is illegal. Avoiding tax is legal. And I'll actually give you 10 ways which you can use to reduce the tax due from your incomes. One of the ways is saving for home ownership through a registered home ownership savings plan. The home ownership savings plan was first introduced in 1995 in the Income Tax Act as a tax instrument aimed at first-time home buyers, in which saving for a maximum of 10 years with a registered HOSP allows subscribers to receive tax rebates of up to 8,000 per month or 96,000 per year, as well as tax relief on interest income from the investment of up to 3 million shillings. So in other words, if you're planning on owning a home, you go to a home ownership savings plan registered scheme like the HFCK, and you save towards, you prove that you're saving towards obtaining a house or a home, then the taxman will allow you to deduct a maximum of 8,000. If you're saving 9,000, they'll allow you to deduct 8,000 from your taxable salary. If your salary is 100,000 and you are contributing towards the home ownership savings plan, 8,000 will be deducted, so meaning you'll be taxed on the 92. But if you're contributing lower than 8,000, then the actual amount will be deducted. If it's 6,000, 2,000, or whatever it is. The other second way to reduce your tax is to register with the retirement benefit scheme. Already there is the mandatory scheme that we deduct towards, that is the NSSF, but there are several recognized schemes to which you can apply for membership aside from the NSSF, which is essential for salaried employees. Savings up to 20,000 per month made through these programs are tax-free. So you'll be allowed to deduct 20,000 up to 20,000. It makes more sense to invest in a retirement plan rather than a standard savings account, since in addition to not being taxed, these plans also provide annual returns of 4 to 7%. And the third way to avoid tax is for persons living with disabilities. You can get a disability relief. Persons with disabilities are assessed by government medical institutions and the National Council of Persons with Disabilities, and they register them on this assessment, based on the assessment. And if you are such a person, you can seek for an exemption certificate. Disabled people are free from paying tax on their taxable income up to 150,000 shillings per month. As a result, if you own a business or work for someone else and don't have an exemption certificate, you're losing out on a lot of money. The fourth way is to take advantage of business exemptions. Many people forget to register side hustles, which is to their cost in the long term, because one, it's legal not to register businesses, and two, you'll not have a chance to deduct allowable deductions. When you have a registered business, you'll be able to document all your expenses, and as a result, you'll be able to claim business taxes. Tax deductions are available for all legitimate expenses incurred in generating income, such as startup costs, advertising, travel, accommodation, rent that you pay on your business premises, etc. So people with hustles, I would advise you to register the hustle, have your expenses well documented. Even if in employment income, if you add your employment income together with your hustle income, you might be able to reduce your total taxable income and the tax due because of all these allowable deductions. If you watch the video on how to calculate the personal and business incomes, you'll see the list of these expenses. The fifth way is life insurance premiums relief. Life insurance is a way to help financially protect your loved ones in the case of your death. Insurance relief is available for group life insurance and other insurance policies, such as an educational policy with a maturity of more than 10 years. Premiums paid would be eligible for tax credit up to $5,000 per month. The payouts on the insurance maturity are likewise exempt from capital gains tax. Number 6 is mortgage interest relief. Interest payments on loans borrowed for the purpose of improving or constructing residential premises are deductible from January 2017 up to 300,000 shillings per year or 25,000 per month. So if you're constructing your house or a business premises or restructuring it, the best way to go about it is, instead of taking a normal loan, you take a mortgage, and then the interest you'll be paying, if the interest is more than 25,000, you'll be allowed to deduct a maximum of 25,000. If it is lower than 25,000, you'll be allowed to deduct the full interest amount from your profits, and thus lower your tax liability. Number 7 way to avoid tax is to save your money. If you have large amounts of money with the post office savings bank, interest earned on fixed deposits is tax-free at the Kenya Post Office Savings Bank or Post Bank. This is due to the fact that the Kenya Post Office Savings Bank Act Cap 493B, which regulates Post Bank, gives a zero rate on interest for taxes, and it's unlike for the banks. Interest earned from other banks other than Post Bank, you will be charged a tax. The 8th way is, if you're in business, is the knowledge that capital deductions will really reduce the tax due on you. Capital deductions, the allowable amount that you deduct from your profits as part of the total cost of investment. For instance, if you invest in a building, that will be called the capital expenditure on buildings. The hotel buildings used for manufacture, hospital buildings, petroleum or gas storage facilities, educational, you'll be allowed a 50% deduction of the total cost in the first year of use, and 25% on a reducing balance for the remaining cost. If you invest in ships, hospital equipment, machinery for manufacture, again you'll be allowed to deduct 50% of the total cost in the first year. If you invest in your business on things like computers and peripheral computer hardware, softwares, calculators, photocopiers, you'll be allowed to deduct 25% of the cost on reducing balance each year. If you invest on furniture and fittings, you'll be allowed a 10% deduction on a reducing balance each year. So, meaning every expenditure you incur for those fixed assets, part of that cost is recovered from the profit before tax. That's number 8. Number 9 is the special business rates. Special business rates happen for people in the export processing zone who pay a tax of 0% for the first 10 years, and for other special zones like local car assemblies. So export processing zone is basically promoting export. So if you invest in such an area, then you'll be exempt from tax for the first 10 years. The number 10 point is very beneficial, especially for the young people. the Ajira digital program. The Ministry of ICT, Innovation and Youth Affairs introduced the Ajira digital program back in 2016. The program seeks to provide young people with the skills they need to earn a living from digital and digitally enabled occupations. The Finance Act of 2019 has introduced an exemption for individuals who are registered under the Ajira digital program from income tax for 3 years, beginning 1st of January 2020. So if you're a young person, register with the Ajira digital program, and any income you earn for the next 3 years, you'll be exempt from income tax. So those are 10 good areas that you can use to avoid paying a lot of tax payments.